Hello everyone, welcome to yet another video in which we'll be talking about value investments in the stock market. All right, so in case you have not seen any of the previous videos we did, I want to encourage you to go and look at those videos because it will help you to contextualize what I'm going to be saying in this video. It's going to bring a lot of the issues together. It's going to bring you to a place of understanding, full understanding of what we're going to be saying in this video. So we have dealt on the matters of debt to equity ratio. We have talked about profit to earnings ratio. We have talked about quick ratio and the likes. We've been talking a lot about fundamentals. This is what makes savvy investors, intelligent investors, intelligent. Their understanding of the basics. These are the basics. These are the first principles, if you like, of stock market investment. So today, I'm going to be taking on some additional fundamentals that are very, very key to decision making as far as investing in stocks are concerned. And so I'm going to be starting out with the metric that is called earnings per share. Earnings per share. So what's earnings per share? Earnings per share is a ratio. It's a ratio that compares the net income of a company against its number of outstanding shares. The net income against the number of outstanding shares. It is a measure of profitability. Okay? The earnings per share is a measure of profitability. It tells you how changes in the operating income of a stock can affect the volatility of the price of that stock. Okay? And then it also tells you how much returns you can make. You see, if share prices are very volatile, what it means is that depending on the kind of investor you are, if you're there for the return on investment and you pick your money and you move away, those hikes or spikes in price, those volatility in price will be a major concern for you. And don't forget that the stock market, there are two approaches. You're either doing it short term or you're doing it long term. So this issue particularly is very, very key for short term investors who are looking to invest in the short term, get value, and maybe move the stock somewhere else or hold it for some time before they move somewhere else. That's why this is important. So like I said, it is a measure of profitability, and the earnings per share is also an important metric that's used in determining the profit to earnings ratio. Okay, so it's important you pay attention to this metric when you are making a decision to buy any stock. Like I said before, I'm going to define it again. It is determined by getting the operating income versus the number of outstanding shares of a company that is quoted in the capital market. So it's a measure of a company's profitability. And let me say this on the final note before I go to the next metric. The higher the EPS, the higher the value or the better the value of the stock. So it tells you that it's a stock to buy. So if a stock, if the EPS of a stock is high, it tells you that is a stock you want to invest in. But if the EPS is low, then it's something you might need to look at other metrics. In fact, you will need, like I said in the previous video, you don't make a purchase decision by just looking at one of the fundamentals. You look at the entirety of the fundamentals. Okay, so there's a possibility that a stock has a low EPS, but it's strong on the other fundamentals. And then those strengths can overcompensate or can compensate for, if you like, the not so good earnings per share. So what it means is that depending on whether you're doing it for the profit or you're doing it for the growth, if you're doing it for the growth with a not so good EPS, if it's a stock that has potential for growth, you might still want to buy. Okay. But if you're not doing it for growth, you're doing it strictly for profit, then you need to check other fundamentals. If the other fundamentals are not so strong, because sometimes EPS might not be so strong, but the company still returns profit. Okay, and that's where looking at everything comes to play. You don't just make a decision on one of the fundamentals. You look at the entirety. It's like a basket, you know. It's like what we call balanced diet in biology. Carbohydrates, proteins, fats, oils, and all of that. You use everything together to arrive at a balanced decision. I believe that is well understood. But as a rule of thumb, the higher the EPS, the greater the value of the stock. And if the stock is valuable, it means it's going to return value to you. Okay, so having said that, I want to move to the other fundamental we're going to be examining in this video. It's called the degree of financial leverage. Degree of financial leverage. It's also a ratio. Now, most of these fundamentals are ratios, okay? Someone once said to me that I don't like mathematics, but I've noticed that when I try to look at some balance sheets of companies, there are so many ratios there, so many formulas and all of that. And, you know, it got me laughing and smiling. It's not the difficult kind of mathematics, okay? It's the very elementary level of mathematics. So you don't have to break your head about those formulas. It's as simple as 2/4 or 4/2 or 8/, you know, simple ratios. They are not complicated ratios. But again, peradventure, this video really interests you and you have that problem with mathematics or statistics, and you're saying, because of it, I'm scared of investing in the stock market. That's why we're here. You can reach out to us. We can hold your hand and help you do the numbers, okay? We can help you do the numbers and walk you through the process of doing this investment. So like I was saying, degree of financial leverage, DFL for short, it's a very fundamental metric to consider in buying any stock. So like I said, it's a ratio. It's percentage change in earnings per share over percentage change in earnings before interest and taxes. Percentage change in earnings per share divided by percentage change in earnings before interest and taxes. So this ratio is very important because it helps you to know if a company is taking on more debt than she can handle. So this ratio works very well with the debt to equity ratio. If you notice the term, it's called degree of financial leverage. When you talk about leverage simply talks about how you use debt, borrowing, okay? And like we said before, most businesses borrow money. Even, in fact, the biggest businesses borrow more money, okay? So you need to look at how well the debt or the borrowing that this company is doing, how well utilized is it, and how well is it returning profits, okay? After they have done interest payments, after they have done taxes on it and all of that, how well is this returning value to the company? It's very important, okay? Because it is also influenced by the operating income of the company. If the DFL is not properly handled and something happens to the operating income of the company, okay, it means that the company will not be able to pay off the debts that she's incurring. So you need to look at it. I hope I'm not making you feel this is complicated. No, it's not complicated. Just pay close attention to what I'm saying. This metric or this fundamental helps you to tell if a company is borrowing more than her operating income allows her to operate. Let me give you an example with small numbers. Let's say company A, quoted on the stock market, maybe industrial goods sector of the stock market, makes an operating income of 20,000 naira. Okay? And then you do the numbers of the DFL and it's showing that the capital equivalence of the DFL ratio can only allow the company to borrow 10,000 naira. Okay? And then maybe at the half-year report of the company, the directors or the board of the company is saying they borrowed 20,000 naira. Their operating income is 20,000 naira. Let's even say they borrowed more than their operating income. That is not a very good way to handle leverage. So it tells you that the management of the company is probably not paying attention to certain things. Okay? And you might want to think very well before you buy the shares of that company. But like I said, like I've maintained in all the videos, now there might be a reason why the company wants to borrow at the same level of operating income or higher than operating income. It's possible they are expanding into a market that would increase the operating income. Okay? So that is where savviness comes into it. So you need to look at all the details. And that's why I said to you, you can't make an investment decision based on one metric alone. You have to look at all the metrics. So having said this, I want to appeal that you go and watch all the videos we have done. We've done a lot of videos, I think 3 or 4 videos already on the issue of fundamentals, on the issue of investing in the stock market. Go and look at all those videos. Go and look at how you can understand all these ratios so that at the end of the day, you can pick each of those items, do your analysis. Okay? That's why you have what you call financial analysts. That's the job that they do. That's the work that they do. They do this for asset management companies. They do this for private equity firms. Okay? They pick the balance sheet of companies. They pick all these ratios and they do the analysis by themselves. And then they advise their clients and say, look, based on all of the analysis that we have done, based on the fundamentals analysis that we have done for this company, it is a good buy. Okay, so you need to go watch all the videos, all right? And in case you are not yet subscribed to our channel, I want to encourage you to subscribe to our channel. The truth is you'll be missing out on a lot of very, very powerful insights that we have to share around making money in the stock market. Let me tell you this teaser before I leave. Recently, one of the big tier 2 banks, not tier 1, one of the banks in Nigeria, released their half-year report for the first half of 2025. And some of the directors in those banks, in that bank particularly, in that bank, increased their shareholding in the bank. For one particular director, the CEO of the bank actually bought close to 20 million units of that bank stock, all right, for 8 naira something. Come on. If you're conversant with share prices, you might be guessing which particular banking stock that might be. Now, why are they doing that? They are the ones running the bank. They have looked at their books. I'm going to buy that share. I'm going to buy that stock because they're based on all of the metrics I just described in the videos we have done. The fundamentals of that stock is good. So even the runners, the people managing the bank are they are lining up themselves to share in the largesse at the end of the year, because CBN has now made all banks to run a January to December financial year calendar. So they are lining up themselves. They're putting themselves in pole position to make very good financial returns on their investment. And that particular bank has a history of paying dividends. So people are going to be making millions of naira. They're already sure by buying those stocks. And they are not afraid of losing money because they know how to measure these things. So what are you waiting for? Go and see those videos. Go and watch them. And then peradventure you see the videos and you have questions. You don't have clarity on certain aspects. Drop your questions in the comment section. We'll be more than glad to assist you, to help you, and to make you a savvy, a smart, and intelligent investor. So on that note, in case you have not yet subscribed to this channel, please do so. Like this video, share it with your friends, share it with people that need it. Until next time, we're going to be doing a video that pieces, there's one more fundamental we need to look at. And then we'll look at how to look at balance sheets, how to look at financial reports of companies, and then we'll tie it all up together. So until next time, I hope this video added value to you. Thank you for watching. Bye for now.